Let's take a look at the uranium market. It's been about 6 weeks since I last did a video on the current uranium bull market. I became interested in the uranium market back in early December, and you can go back on my YouTube channel and look at some past videos on uranium. But when uranium broke out on a massive increase in volume back then above the 30-week moving average, and then really started looking like a new stage two bull market when it broke out again in January of this year on a huge increase in volume and started establishing a new stage two uptrend. This is the uranium mining ETF URA, and you can see that it's been pulling back over the last 3 or 4 weeks to the breakout point above resistance, which is around $15, and you can see that resistance level was established back in 2016 and even back to 2015, where after being in a bear market, the price was unable to get above that level on a couple different tries. And then on the latest breakout, you see how it busted through this level on a huge increase in volume, which is what, according to Weinstein stage analysis, what signifies a new stage two bull market. Now, the pullback to the resistance level is typically called the second ideal buy point, and why it's the second ideal buy point is that it's actually a low risk point to buy because you can set your stop right above the point where you would be wrong, where the price would move back below the moving average and potentially set up either a resumption of the bear market or just a continual stage one base before the bull market would really get going once again. But it's a point to where your risk reward is very favorable because you have a low amount of risk to determine where you're wrong. So if you look at the graph of the ideal buy points, the first ideal buy point is the break above the resistance, and the second ideal buy point is the retest that often occurs after the breakout. Now, in the strong bull markets, a lot of times a stock will just continually move higher, especially because new bull markets tend to produce rapid gains. But sometimes you get these retests, especially in sectors that are volatile, and that certainly is the case for uranium. So a lot of times in more volatile markets, you'll see that retest, which again is a great place to do some buying and have a favorable risk reward. And you'll notice that the on the stage analysis screener, a lot of the uranium stocks are now barely above their 30-week moving average. You can see that Energy Fuels, for instance, UUUU is actually a little bit below its 30-week moving average, but some of the other major mining stocks like Cameco and Denison are only like 4.5% and 6% above the 30-week moving average. So you have uh, a low amount of risk to determine whether this bull market is going to reemerge at this point. Looking at a chart of Cameco, you can see how it broke out the first week of this year, and then it's been consolidating ever since. Cameco's had a couple news releases that were unfavorable for the company, but one good sign is that it still maintained the moving average even with some of the negative news, and that's a good sign for the bull market in the stock. Denison, again, just like Cameco, broke out early this year, and it's had almost like 8 weeks now of consolidation, and again, it's getting close to the 30-week moving average once again. Uranium Energy, same kind of thing, where some of the uranium mining stocks were actually able to make more recent new highs, but most of them have then fallen back towards the moving average over the last 3 or 4 weeks. And one good sign too with the pullbacks in a lot of these stocks is that it's occurred on lower volume, which typically signifies that the early buyers are not giving up their shares and really the selling is being distributed by a lesser volume of sellers than what occurred on the breakout, where more stock was consumed by people wanting to get into the market. So typically, it's not always the case, but the low volume is a good sign on a pullback. Next Gen Energy actually made a new high up until just 3 weeks ago, and what's typical, what you see in the stronger stocks in a bull market sector is that you'll see more strength late in a uptrend in the strongest stocks, and then they'll have a sudden pullback as they finally succumb to the overall pressure on the sector, versus the weaker stocks. We'll start to see more distribution earlier at the end of an uptrend, um, and the stronger stocks will maintain on. So that's kind of how that goes. But again, notice on next gen is still above a rising 30-week moving average and is still well above the moving average at this point. Now, one of the contributing factors to the recent weakness in the uranium mining stocks is the overall weakness in the commodity sector. And we've seen weakness actually in the commodity sector since early this year, and it's kind of accelerated itself over the last couple of weeks. Notice the GCC ETF has been pulling back over the last few weeks, and it's kind of in jeopardy of maybe going into another new downtrend here. So this is definitely something to watch. Another thing to look at is the oil market. Oil really had a tight consolidation for the last few months and had a huge down week last week, losing about 9% on heavy volume. And this is going to be something to watch because oil is a big part of the commodity sector and is once again sitting right at the 30-week moving average, where the stage kind of 2 uptrend that it started out in April of last year could be in jeopardy if this selling continues. Natural gas is kind of in the same situation where it's been under pressure all this year so far and has rallied the last 2 weeks, but is touching resistance at the 30-week moving average, potential resistance, and we'll have to see what happens, whether it can kind of maintain this kind of weak stage 2 uptrend, or if something worse is going on and maybe it continues to move lower further. And the US dollar is kind of interesting here because it is still in a stage 2 uptrend, but the bounce off of this 30-week moving average since early February has been fairly weak. So it's kind of at a crossroads and could have definitely major influence on the commodities markets. And if it does actually happen to break down, it might be interesting to see if the commodities markets reverse their recent sell-offs. But as of right now, it's still in an uptrend, and until that changes, that's the current state of the US dollar. Now, turning back to the chart of URA, what we want to see over the next 2 to 3 weeks is URA finding support around this resistance level and above the 30-week moving average, and then a continuation of the stage 2 uptrend once it finds support in this current pullback. If it were to break down below the moving average and below resistance, that would be a negative sign, and at that point, according to stage analysis, you'd want to reassess your positions and potentially exit the market, as the bull market would be more in jeopardy of morphing into either a continuation of the stage 1 base or even potentially signifying a resumption of the bear market. But since the breakout earlier this year was so explosive, you know, signs are that the market has a good chance of finding support here and reestablishing the stage two uptrend. But of course, anything can happen in markets. And as a disciplined trader, you should be prepared for either situation and should have your stops in to minimize damages in case the market does break down and morph into a more negative market.